Welcome to the Wheelbarrow Profits Podcast, where you get multifamily investing made real. Learn from top players in the real estate investment world as they share their secrets with you and discover proven strategies on apartment investing that actually work. To learn more about Wheelbarrow Profits, visit jakeandgino.com, your one-stop shop for everything multifamily. Now to your hosts, Jake and Gino.
Hello, everybody. This is Jake Stenziano, host of the Wheelbarrow Profits Podcast, here with my co-host, the multifamily mentor, the coach, the chef, the father of six, the best-selling author, the G-Daddy, Gino Barbaro. Gino, how's it going?
Stenziano, I'm doing good. How you doing?
Man, just trying to keep pushing these deals through, make it happen, and that's about it. Loving. Shout out to the Folios for the beautiful knives they sent after the live event. I know you got a set as well.
Yeah, they did a great job. It was an awesome present. Thank you. It was great.
Yes, very much so. So, hey, before we get started, let's give a quick shout out to our sponsor, CrowdStreet, who knows you don't have to know a guy to find a quality commercial real estate investment opportunity. Learn more at crowdstreet.com/wheelbarrow, and for visiting their site, they're going to give you a free guest. Today's guest is Eddie Lorin. Eddie is a 30-year multifamily veteran and the founder of Impact Housing, a real estate investment trust. Since 2001, their team has successfully purchased and transformed more than 40,000 apartments nationwide. Wow, that's a big number. So without further ado, Eddie, welcome to the show.
Thanks for having me.
Hey, thanks for being here. How did you get into multifamily, and how did you start this impressive business?
Well, I started in most of the food groups when I got out of UCLA. I actually began doing office, and then I went into industrial, ended up in retail and triple net lease investments. And I found that a lot of those are really hard as an individual or as a small company to be able to compete with. So tenant improvements, leasing commissions, very, very capital intensive. Oftentimes you don't make money for 5 years in an office deal. So I went through that in my 20s and found multifamily to be very easy, nimble. Well, nothing's easy, of course, but you can be a lot more nimble. They're 1-year leases. They're actually people. And I found that I had a real great eye for how to transform properties, have the vision to be able to go in and rehab them, take neglect or blight and make light, as I like to say. So it's been an interesting opportunity for us, and you get better and better at it as time goes on, and just kind of find your niche.
What was your first multifamily deal? Do you remember it?
Do I remember it? Actually, I bought 100 units in Orlando. Very good. It was $12,000 a door.
Whew.
And not seeing those prices these days, right?
And it was a great opportunity. It was really, really messed up. And we actually emptied it out to 30% occupancy, and were able to transform it and do a lot of improvements. We spent another 10, so we're in 20, and we sold it for 34. And thought we hit a home run, which we did at that time,
Uh-huh.
Yeah, for sure.
In fact, some of those prices came back very close back in 09, 010. We bought a couple very similar prices then. So,
What year was that? What year is that for deal you bought it in?
The first one was 01. The second one that came back around was 010.
2010. So what have you seen the difference in the market? I mean, and now in those whole market phases, you've been through like nice 2 or 3 market phases. What is the difference buying now as opposed to buying back then?
Back then in 01 or
in 01? Yeah.
Oh, well, the whole market has gotten more sophisticated. A lot of institutional and foreign players are involved, and it's a very much more efficient market. You could find better opportunities, of course, before, because the opportunities were sparse and it wasn't that sophisticated, honestly.
Mm-hmm.
So that's what's happened. Is the sophistication has been huge.
So why don't you talk to the viewers and tell the viewers your business model? I mean, how you came up with the business model and how it's transformed over the years.
Well, we take, like I said, we try to take neglected properties and make them transform. Let me just turn this off so it doesn't ding again.
Airplane mode.
Yeah, that's right. We go in and we try to start with a sign. We want someone to see a sign. Let's say you have 100 or 200 units. That sign, they can only wish they could afford to live there. And then once they get inside, they actually can afford to live there. So we come up with multiple paint schemes, attractive common areas, state-of-the-art fitness centers, resort-style pools, renovate the units, but don't renovate them with too much because you don't want to over-improve them. We're looking for a lift on, say, $50 for the exterior renovations and $50 for the interior renovations. So rents are at $700-800. We're looking for a $100 lift over a couple of years, and we, kind of smooth it out over time. Lately, we've been getting more into the affordable space because there's more opportunity there, we feel, for cash flow for our investors.
So what are your buying parameters? What are you looking for when you spot a deal?
We look for an IRR that's probably in the high teens on a 5-year basis. We're going in at, somewhere 5-6 and going out at the same cap rate or a little higher. And we look for that lift, as I say, about $100. And that IRR is achieved by moving the rents to a commensurate level so you can sell and make a nice, decent profit.
Do you
refi out?
That's what I'm saying. Do you hold any of these properties long term, or do you tend to?
It depends on your capital. This new venture we have is a crowdfunded REIT, and our goal is a 5-year hold. So the capital drives everything. If you have your own individual capital, we have properties that I've owned for 15 years. It depends on your business plan. So it's really always dependent on the capital. The capital drives absolutely everything.
But what do you prefer to do?
Obviously, we all prefer to have patient, long-term, cheap capital that will last forever.
You'd be surprised. There's a lot of syndicators out there like to get these deals, like to charge the acquisition fees, like to turn them in 3 years, flip the money, make 50% on the back end, repurpose, continue to do that. I call them the master fix and flippers. So, obviously, it doesn't seem like you like to do that. So that's a big difference in the model.
Yeah, we also.
Sorry, go ahead. I was just going to say, I'm still, I go back and forth through this Powerhouse Principles book that we talked about the one time. And there's actually a debate in there between these two guys. One guy literally loves to just get in there, renovate it, and get out, whether it's his capital or investors. And the other guys argue, no, you got to hold these things long term. And I think it's fascinating. I prefer the long term hold personally. I like the cash flow, but.
Well, here's an interesting tidbit on that. The low income housing tax credit scenario is that properties are in a 15-year compliance period where the tax credit investors get basically they get a tax write-off for investing, but they have to hold for 15 years. And the model is to make a fee up front, but long term there's no incentive to capitalize. So if you can buy them in years 13, 14, 15, they tend to be neglected. So you can't hold properties too long without refreshing. So you got to at least have a refi in there that's a lot sooner, because properties do get tired. Paints fade. Roofs become a problem. Demographics change. You have to be nimble with your rents. There's so many things that are important to take into account. But the bottom line is, you have to be incredibly diligent at asset management. So many people forget that. Neglect can so easily end up in disrepair. And that's why you have to be really, really careful to not only have the capital to spend, but the elbow grease to spend.
So where do you see the market going? I always like to ask people, somebody said he's tying into the economy as the economy and jobs drop. He's afraid of multifamily. Where do you see it going in the next 3 to 5 years?
We have an affordability problem across the country. We are losing affordable units, about 150,000 a year, and we're only building 50,000 a year. There are many, many opportunities for people to rent on the high end. There's a ton of product, but those luxury rents are $3,000, $4,000, $5,000 a month. They're not sustainable. They're not affordable. I've always played in the affordable game. We try to give people a clean, safe, affordable place to live, treat them with respect and dignity. They tend to stay, pay, and they refer their friends. It's not a sexy business, but it's a solid business. And as time goes on, you can't build B and C product. You can only build A product. And yes, that does trickle down ultimately to the lower end. But when your rents are averaging $800 to $1,000, it's really hard to get hurt. So I don't see much movement on the downside. I think that our place of affordable and workforce housing is a very defensive play for years and years to come. And you've got it. Look, it's all about supply and demand and jobs. And short of losing jobs, we're at full employment. if we don't lose jobs, there's going to be demand for affordable and workforce housing at up to 100% of area median income, and even up to 120%.
I really like that.
A tale of two markets: the A market, and even it's softening. I just get back from New York yesterday, and the higher end rental market is definitely seeing some issues. But you're talking about the 5,000-6,000 range, not in the 1,000 range.
But isn't that a supply issue? Also, they're building so much of it, and that's all they can build right now. Because if you're building 120 a door, you've got to get $1,500 to $2,000 a month in rent. You can't build the Bs. We've been trying to build, Jake and I, in our area. We've got our own. You can't get in for less than 80 a door, and land prices have just escalated. So that's part of the issue right now. We're trying to build B and C product. We can't, and we fall into your space. We're in the C space. We love that space. We call it we're the mom and pop kings. That's what we look for. We love those tenants. We love the blue collar tenants. We love that area. And that's where we strive in. So we have a total alignment with you. Unfortunately, the mobile home park space they have such a stigma. They're getting pulled down. People are tearing them down. That's where affordable housing should go, because it's a great place, but they're not getting built.
They're getting more expensive too. And, I was going to kind of piggyback off what Eddie said, because, the guys that are going in and buying the C product and putting 10 to 15,000 a door in there, they're trying to get the rents up significantly. If the A market ever gets oversupplied and they have to push their rents down, they're going to be bumping into these guys. And that's why we're trying to be recession resistant and play in that $800. If we buy something, we're trying to keep the rents in a place where it's affordable so we can keep tenants long term. We'll go in and do some light updates, but we're not trying to go in there and put 10,000 a door in, since we're holding these things long term. And to your other point, keeping the outsides nice, making sure the gutter leaves are getting cleaned out, making sure that any of these little deferred maintenance things are being handled. If there's a little bit of siding falling off or whatever. I mean, these things, like, to his point, over long term can exacerbate and create bigger problems. Mm-hmm. So it's just keeping these things dry and safe and clean. So I just appreciated what he had to say there. But.
So let me ask you, Eddie, where are you buying right now? What markets do you like?
Always have loved the Sun Belt, but I also have an institutional fund where we're investing for Community Reinvestment Act, and the banks invest with us. So buying in upstate New York opportunity. There's never a good time to do a bad deal or a bad time to do a good deal. You got to make sure that there's a disconnect between what the seller sees and what you see. And you can always have vision and transform something. And especially like we are all talking about, on the low end, it's really hard to get hurt. And so I really believe strongly in these markets. Dallas, I love. Colorado Springs, we just bought. Vegas, we're buying. And, with this tax reform, it's really concerning for a guy in California like I am. I think a lot of people are going to be moving toward those markets like Nevada, like Dallas, Texas, where there's no state income tax, because this administration's sending a real FU to us blue states, New York, Illinois.
It's funny. We actually both left. I left a few years ago because I was sick of paying state income tax, and I moved from New York to Tennessee. He actually moved from New York to Florida, and I'm interested because you said upstate New York. I'm originally from upstate New York. Go Bills, baby! Go Bills! Come on, you got to get the Buffalo Bills. So, what part of upstate New York are you investing in?
Well, it's just we happen to find a deal in Rochester, New York, and
going back to the old stomping ground, Gino.
Yeah, it's a tough market. I bought a couple of duplexes back in 2008. It's just a Section 8 up there. It's just no jobs up there. There's no job growth at all. It's a stagnant market. Now, I know it's revitalized because the University of Rochester is going on. Right. I know the downtown is getting built, but they're building a lot of new supply. But a lot of parts of the city are really depressed. And there's just no, if you don't buy right there, you can get stuck there for the next 20 years. It's a very linear market. If you're buying for cash flow and you have a different model, yes, you can buy really right. You can do excellent there. So that's an attractive thing. But for me not being in the market, it was just difficult for me. I couldn't scale up there. And I bought in 2010, and it was just a difficult market at the time. Now I know the downtown's being really revitalized. So how big is the deal you're looking for there? Is it a bigger asset?
Yeah, it's a very large deal, but it's an institutional deal. The point is that it depends on the capital. The capital drives absolutely everything. My career has been primarily institutional capital. And my expertise is transforming properties using institutional capital, and now that's why I've gotten into the Reg A Plus market in terms of making impact investments through affordable housing. and workforce housing. So that's the opportunity for, the non-accredited investor can invest as little as $1,000 now. So it used to be that only the big players could play in this arena. And that's why I'm trying to democratize workforce housing investments. It took about a year and a half to get through the SEC to get this validated and endorsed. And so we're just launching this opportunity, and it's a really great venue for people worldwide to invest. Whereas it used to be only for the accredited investors or the people that made at least $200,000 a year and had $1 million net worth. So, and so people all over the world or in the United States can come direct to us on the internet at impacthousing.com, and they can make as little as $1,000 investment, and they don't need to open a brokerage account at Schwab or at Wells Fargo or any of those wealth advisors. So the millennials are changing this market. There's going to be about $14 trillion of wealth transferred from the older generation to these millennials, and they are more comfortable investing online and taking their investments not only in their own hands, but more important, they really want to make a difference. So what is an impact investment? An impact investment is something that is a double bottom line, whereas you get a financial return, but you also make a social change. And that's what I've been doing forever.
That's awesome. So do you think this is one of the first platforms that addresses that? Because you're also creating communities. You're creating communities and you're allowing people with lesser means who have a 401k or who have a little bit of savings to throw into your platform. It sounds like this is one of the first platforms to address that. Is that correct?
Yes. You've heard of Rich Uncles and Real Crowd, but a lot of those are nobody's in the workforce housing space, let alone caring about impact investing. So yes, I feel like I'm a champion for the underdog, the working poor, and of course for the investor that has every right to invest and make the same returns as the institutions.
So you just mentioned you take investments as low as $1,000. Did I hear you correctly?
Yes.
That's impressive, because I know a lot of guys don't want to mess around with anything less than 100. It just, because it's the management of the investor becomes challenging. Are you managing through a back-end software, and has enabled you
That's
to?
CrowdStreet, your sponsor.
CrowdStreet, yeah.
Oh, I was waiting for He's giving a little plug to the.
I got you guys.
Oh man, crank it up.
This is their first Reg A Plus offering as well, so it's a nice partnership between us. It's a challenging and transforming business. And it takes a lot of back-end engine work, and we also use a stock transfer agent. So a lot of things are very automated, and the world has changed with technology. So it's less intensive on our end, but we still have the auditors and everything that a REIT has. It's more, democratized. It's really better for the individual, and it's easier for the operator now. Thankfully, that the last administration passed this Jobs Act, which allows non-accredited investors to come in. But, we are more scrutinized than a private REIT because all eyes are on this, and they're consultants.
Eddie, how did you come up with the idea? I mean, where was the idea that came up with the crowdfunding and with the impact housing? Where that?
Well, I've done a couple crowdfunding Reg D deals, which is for accredited investors. And when I found out that the opportunity is coming up and exists for non-accrediteds to join in, I was very excited to have the opportunity to be able to go out to the masses and allow everyone and anyone to be able to invest. But I have always been an impact investor. For 20 years, I've been doing this. Transforming and taking blight and making light is really what it's all about. So the result is that it's been incredibly rewarding, and the opportunities are there to get solid cash flow and make a difference in people's lives. We promote health and wellness in our clubhouses. We have a nonprofit we partner with that gives them a social impact as well. So not only is renting to people at 80% of AMI or less, and what's AMI for those of you who don't know? AMI is area median income. Everything is tagged in the affordable housing space to area median income, and those rents are commensurate. So let's say the area median income in a property in a county is $50,000. 80% of area median income is $40,000. And so no resident should pay more than 30% of their 80% of the area median income, if you're following me. So as a result, the max rents that we would charge are 12,000, 3 times 30 times, the 40. And so as a result, max rents would be $1,000. Now, if someone makes $11 an hour, they shouldn't pay more than $550 in rent.
Mm-hmm.
So that's where Section 8 comes in. That's where government assistance comes in. And unfortunately, there's not a lot of political will at the top in this new administration to help fund these people, the working poor that have one foot on a banana peel, unfortunately. So there's a lot changing in this marketplace. And so it's going to be very, very challenging to make sure that everybody stays housed going forward if this new tax reform passes, whether it's the House or the Senate bill. It's a very tenuous time for us all in this country.
So Eddie, let me ask you, if I'm an investor and I want to get into your space, what would you recommend me to do? Like a little framework of trying to get into Section 8 or affordable housing. What would you tell them to start doing?
Well, depends on how much capital and what it's the capital and how much, what's the goal for that capital?
Okay.
If you're looking for a long-term investment and you can find an opportunity that allows you to be able to invest the amount of money that you want to invest, let's say you had $500,000 or $1 million, you don't need to go in with others, you want to go in on your own, you try to find an opportunity where maybe there's a way that you can take some of the neglect and transform them into better opportunities so you can raise the rents, but not so much that they're unaffordable. Because we talked about earlier that $4,000 or $5,000 a month space is going to get really impacted with the thousands of units being built.
Mm-hmm. So my issue is, or question is, how is it working with HUD? Because Jake and I have come upon this. We just bought a property. We find it daunting as first-time investors trying to deal with HUD and trying to deal with Section 8. Any recommendations on that?
Third-party management is very important because they are experienced. They have relationships with the housing authority and the housing commissioners. And oftentimes, like in Beaumont, Texas, we have 5 properties. There are 7 different agencies that actually provides vouchers. So I wouldn't even try. Literally.
I know.
Third-party management.
It was a small deal. We picked up like 64 units, and there's a section of it that has a HUD con. It's only like 24 units.
Oh, okay.
And so I think they're gonna help us. We got a guy that wants it, right? The funding. So we're gonna just try to roll it out, essentially. But
so then, Eddie, where do you find third-party management? I mean, just give me an example of how people can find third-party management.
Well, I've used them my whole career, so I know most of them. They're all the major players are there, or you can find people that are in the local chamber of commerce. Find who's the best apartment manager, or call the housing authority. They know who's good and who isn't.
Okay.
Because if that's the area you want to play in, you've got to go to the source. And HUD needs, they need to inspect every unit before they allow someone to house them and provide a voucher. And by the way, there's no crime in taking vouchers. Vouchers are so valuable. There are thousands on waiting lists across the country. So if someone screws up, they'll lose their voucher and they'll never get back on the next on the list. Mm-hmm. And with the cuts coming from HUD in Carson, you're going to have no more vouchers being issued.
So, you think they're going to get kind of grandfathered in? Is that what you're thinking?
If there's no money, what do? You just stop issuing more vouchers. You're not going to cut the people who have vouchers, but as they fall off the rolls or die, they're not going to reissue them. So I think HUD vouchers are going to be huge in value. Mm-hmm. And people are going to guard them with their lives because they need them. Take the average old person who can only afford on their fixed income $200 a month, and they're getting paid $900. I mean, the rent's $900. The voucher's paying $700 of that. They're not going to risk losing that. Most of these properties and these assets, which are an asset to these people, these units are immaculate. Mm-hmm. A lot of pride there. It's not, they're still qualified. They still pass a criminal background check. It's not like it's total projects here.
Mm-hmm. So let me ask you, we talked offline before about the tax reform. What do you see with this tax reform bill and how it's going to affect the affordable housing?
I think it's going to make the problem worse. There's no political will at the top to help the working poor, to provide the opportunities for people to be able to compete. And these are working people, working class people. Now, when you lower tax rates, they build affordable housing, low income housing tax credits based on the tax code. So if the taxes are 39%, a tax credit and the amount of capital that's raised is worth a certain amount. If you go down to 20%, then that tax savings is less.
Less, yes.
So there's less equity that can be generated from the tax savings in theory. So now you're going to have, let's say, a $10 million project that you needed to have some soft money from the government, which is not there anymore because the government doesn't want to even do that. Let's say you have the typical capital stack, $10 million to build a low-income housing property. You get $5 million in bonds, which, by the way, the House bill wants to remove those 4% bonds, which I don't believe is going to happen because that will kill the entire industry.
Mm-hmm.
So chances are that the Senate bill will be more relevant than the House bill. But let's say the 4% bonds stay in place, that's $5 million of the capital stack. And at 39%, the tax credits that one would be willing to buy are, let's say, $3 million. And then there's another $2 million of shortage that can be founded or funded by the government or, foundations, whatever. So now lower that from 39 to 20 or 22 or whatever they're ultimately going to end up with. Now you've got a gap, and that equity is really only, instead of 3-4 million, it's 2 million. So now that gap is even bigger. So what's going to happen? They're not going to get built. Exacerbate that across the entire country, and your 150,000 units that are needed, that are expiring, are not going to stay there. That's why we try to preserve them. Mm-hmm. And you're only building 50,000. That 50,000 that you're building, you're losing 150,000. 50,000 is going to become 25,000 every year.
I just had an epiphany from what you've been saying, because you touched on the fact that some of the states in the Northeast and California are going to get, people that are making good money are going to get hurt really bad because of state income tax, some things that are going to go through this. The interesting thing, to your point, so you could see a mass migration out of some of the Northeast and California, because, for example, I live in Tennessee. You can get an apartment, a nice apartment, for $500, right? So if these people are getting vouchers, so it may, if they can afford a $500 apartment, it may force them into a state that's more affordable, simply because they can then afford the housing. And to your other point, folks that, if you're in Connecticut or New York or something, and all of a sudden you're getting just creamed because you can't write off these state income taxes, you're going to say, why the hell am I staying here if I can go, a few states down and I'm going to make another 10% just by moving. It'll be very interesting to see how this plays out, or if people just eat it and try to figure it out. So it's very
hard to move if you have a job, especially as you get older.
Yeah.
Well,
look, I'm not trying to pin up a debate about how the challenge. I'm just wondering if
the challenge, Jake. This is the challenge. The challenge. People always look at the young. See, we can't move. I did. I just decided to move. I've got 6 kids, but I'm thinking about my children. So states, they don't think of the young, 18, 19, 20, the guys who are going to start becoming earners. Those are the ones they ultimately lose. They lose in the future generation. And that's what states aren't looking to do. They're losing those people. And they're saying, well, the top end earners aren't going anywhere because they're comfortable, they're making enough money. But I think they're losing the cream of the crop. They're losing the guys who are about to start making the money. And that's why I think states have to start shifting their ideology. But what do you see as far as that void? How is the market? Because whenever there's a void in the market, people fill in that market and they come take. What do you see taking over that space, or actually offering or coming up with a solution to that problem?
Impact investing is the only way. Foundations, endowments, and every major institution, their wealthy advised clients are going to force this issue. Mm-hmm. I want my investments to have meaning, not just a financial return. It's the only way. Because where the government didn't have the money before, now the government doesn't want to help. So who fills the gap? Philanthropic investors. And that's what the whole space of impact investing is. And that's what you're going to see transform.
That's great. I like that. Jake, you want to go jump over to the short answer question?
Yeah, but let's give another shout out to CrowdStreet, who believes investors of all sizes should have access to quality commercial real estate investment opportunities. The CrowdStreet marketplace features vetted commercial real estate investment offerings from over 100 sponsors from across the U.S. Download a free copy of the Commercial Real Estate Investing Guide at crowdstreet.com/wheelbarrow. CrowdStreet getting some love today, Gino, huh?
Yeah, showing the love, bro.
A little bit. So we're going to transition a little bit, Eddie. You've been a very successful guy, so I always like to try to jump in your head and see what's made you tick over the years. Can you tell me if there is a habit that you do on a weekly or a monthly basis, something that you do routinely that has led to your success?
Wow. It's persistence. This business has never been easy. And you have to believe in yourself and believe in your purpose and your mission, or you can never get up and do what we do. It's a very challenging time, and it's been challenging over the years. Lenders are competitive in their nature. You have a lot of risk involved in this business. You have to go hard, where sellers are wanting you to go hard, and you don't necessarily know if you have your deal together. So it's a matter of believing in your gut every day that you can put these deals together and that they make economic sense. Because oftentimes people do not believe in see the vision. The more blight you want to transform, the less people are interested. So that's the most important thing, is you just got to believe in yourself and believe that what you're doing has purpose and meaning. Otherwise, what are we after?
Money is not the cause. Money is the effect. That's what it's all about. You're not working for money. You're working for a purpose and a mission. And the more successful you are, the more money you make. That's what it really comes down to.
And it's everyone's obligation, especially at the higher end, to help repair the world. The working poor can't repair the world. They're just trying to make a living.
Mm-hmm.
So the fact that we're seeing tax cuts all the way up to the top and very little at the bottom is very disconcerting. And so that's what this whole world of impact investing is, and that's why it has to fill the void.
And to Eddie's point, he was talking about the persistence there. It took Gino and I 2 years to get into our first deal. It wasn't a glamorous deal. We got a lot of rejection. People told us we were crazy. We got no. And so there's a lot of truth to what he said there. Even this last deal, it took us 18 months. It took a long time, and you really have to be in it to win it and not quit, because it's a challenging market right now. Asset prices have increased, and it's harder to find a deal. So there's a lot of truth to what he said there. Over your career, what's been your biggest mistake?
Overexposure to one or two investors. You do too many deals with one investor, they own you. And that's honestly what has been a very troubling issue for us. Mm-hmm. So unfortunately, you try to diversify. That's what the auditors come in and say, right? You are overexposed to one or two customers, it's a problem. Mm-hmm. You need to make sure that you spread your investment and you spread your opportunities. And the other thing is in markets, I'm a nationwide player, so I like to go in markets that are kind of underserved and give them value and give them a really great place to live. And like I said, they stay, they pay, they refer their friends. So, diversification across all classes and markets. And the other thing is, you got to stay focused. I have thankfully always in workforce and affordable housing, and that's the most important thing. You have to stay focused.
Hashtag CrowdStreet. That's why he's loving it, right, Gino? Spread it across, maybe. Is there a book that you read on business, investing, commercial real estate that you'd like to recommend to the listeners?
Well, it depends on who you are as a person. I'm a worrier. I'm Jewish. That's my nature. And my Bible is a Dale Carnegie book called How to Stop Worrying and Start Living. And I've always referred to that for many, many years because I tend to fabricate a lot of things that could happen, but that's how you are able to be defensive in the world and anticipate, but you also can't let the worry overshadow you. So that's kind of what I've always used.
Mm-hmm.
That's really cool. And I keep going back to this Powerhouse Principles book that he actually used that as his driver to make sure that he wasn't screwing things up. He would let the fear drive him, and he said it almost made him a perfectionist. So it's you got to take that and turn it into an asset almost. So that's pretty neat. What's the best way for listeners to get a hold of you? Say that, there's someone out there listening and saying, I'm not ready to jump in and buy a deal by myself yet, but I like Eddie's message. Is there a way that they can go out and see some of the offerings that you have?
Yeah, just go to www.impacthousing.com and check it out. Our track record's there, our a couple of videos there, a few other podcasts I've done with Adam Carolla, interesting ways to learn about affordable housing and the issues that face our country. And that's the best way to do it. Or you can email me at Lorin, Lorin, at impacthousing.com.
I think it's really cool that you're letting folks get in for $1,000, because that's a lot of work, on your folks and to be able to take all that, because you're going to have to manage that. So very, very cool, and great job opening it up for more people. So Gino, do you have anything else?
I think everyone should visit the site. I've been on there. That's why I knew he used CrowdStreet. I like it because it's a business where he's trying to add value, and he's got a purpose. It's not just about making money, although we all have to make money, but that's not what drives most people and what drives successful people. I like the space. I think it's a great business model that he has, very similar to ours. And I agree with a lot of his points. We need more leadership at the top. That's what we need. And I think that if there's a void in the marketplace, that's what entrepreneurs have to do. We have to come in and fill that void.
Cool. Eddie, thank you so much for your time.
My pleasure.
Thanks Eddie.
See you guys.
We trust that you enjoyed the Wheelbarrow Profits podcast. Visit jakeandgino.com, your one-stop shop for everything multifamily. See you next time when Jake and Gino share more of their investing secrets with you.